Welcome to Market Movers. I'm Jim Uria with Scott Martin.
Hi, Jim.
So 1 year ago, this is the anniversary of what I like to call the return of volatility. It happened right at the end of January. At the beginning of February, we dropped 11% in 3 working days. Then the whole year was characterized by a lot of volatility. Do you believe we're out of the woods when you look at things now?
I don't believe so. And I like how you brought up, Jim, you name things very well, by the way. How you brought up that scare that it got everybody into, right? That it put into everyone. Because if you thought about it, after that small little period, you mentioned it, 3 working days, the rest of the year, until the end of the year, was pretty benign. So I believe it's one of those things that you just keep in the back of your mind that can occur based on a randomness of things.
Okay, but a more broad question is, does a fundamental change in the story cause that dramatic return of volatility, or is it market position? Is it complacency? Put a finger on it.
Fundamentals can do it, but gosh, Jim, it's
rarely though, right?
Rarely, right. And that's the one thing. Fundamentals can still guide you through what I think is, to your point, psychological overconfidence that the market tends to have, where black swans swim up.
Right, and everyone was bulled up. Complacency and volatility were low. It was just a tiny little thing in the unemployment number. It looked like wage growth had ticked up a little bit, and that's what caused 11% move? No way. That's just the straw, right?
Absolutely.
Now, before we dive into our trade discussion, I'd like to point out these are examples, not recommendations or advice. When we priced these out, the S&P 500 was trading about 2730, Scott.
Yes, Jim, so talking about complacency, talking about patience now that the Fed seems to have, seems like a little bit of a similar setup, given that we're coming into February now and seeing just kind of what's going on. So today, Jim, seeing that I have a lot of longs in this market, I'm looking at an example of buying the week 1 March 2650, 2600 put spread for about 5.5 ticks. This trade expires March 1st. It risks 325 to make potential 2175. You mentioned the underlying prices in the ES. Just given the fact that if you look at a lot of those oscillators out there, looking at relative strength, looking at stochastics, looking at just general market psychology, it feels like we're in one of those periods again where some volatility could tick up.
Well, you know what's funny is like that's priced so cheaply, I think, and it almost seems like the market's looking and saying, well, it's 80 ticks away from where the market is now. That's never going to happen. And it was just a couple weeks ago where we do 80
Seems
ticks
like a great deal.
Snap. So to me, and then you see the VIX come back down to 15.5-ish. I agree. I think volatility has come back down low to make these option strategies relatively attractive. And I'm looking one that's similar to yours, but a little bit more aggressive. I'm looking at buying the week 1 March, same date, which is March 1st, the 2675, 2625 put spread for 7.5 ticks. It risks 375 to make 2125. Again, and one of the reasons we're talking about taking advantage of the low volatility, that's why we widen out these spreads and give it a couple extra weeks, because you get more for your money in these environments.
You do, and given that risk-reward profile, and given what I mentioned earlier about having a lot of longs in the market, it seems like this is one of those position expressions you can manage a little bit just because of the smaller outlay. Also, given the fact, too, that you mentioned with the way that timing is set up and the levels that I chose, Jim, which is where that level on the top end of that put spread, that's kind of a breakout level to me in the S&P anyway. So that would be something that I think the market would generally maybe align itself down to if there was a tick up in volatility that we're maybe looking for.
So do you, when we both talking about these trades, are we looking at this, and I know what I'm looking at, are you looking at it as more of a hedge or more of a speculative play to take advantage of a downward move?
More of a hedge and more of just a cost-effective way to take on what I believe is the current market scenario that gives a favorable risk-reward in that case.
I'm looking at it too. The 16% move from the lows we've had in the last couple weeks.
Seems like a lot. Look at all the notes that January got as far as the upside.
Absolutely. Thanks for joining us on Market Movers. I'm Jim Urio, where we're helping to make you a better trader.